Discover the captivating realm where psychology and finances intersect. Welcome to the psychology of money. In this eye-opening journey, we'll explore the intricate ways our emotions, biases, and beliefs shape our financial decisions. Unravel the secrets behind your money habits and gain valuable insights to make smarter choices, grow your wealth, and achieve financial well-being. Join us as we delve deep into the fascinating world of human behavior and its profound impact on our financial lives. Get ready to transform your money mindset and take control of your financial future. Emotions and financial decision-making. Emotions play a significant role in financial decision-making. Fear of financial loss can lead individuals to make conservative choices, avoiding investments that may offer higher returns but carry more risk. Greed can lead to impulsive actions, such as speculative trading or excessive spending. Overconfidence can make people underestimate risks and overestimate their ability to predict market movements. Recognizing and managing emotions is crucial for making sound financial decisions. Cognitive biases and heuristics. Cognitive biases are inherent mental shortcuts that can lead to systematic errors in judgment. The confirmation bias makes people seek information that confirms their pre-existing beliefs while ignoring contradictory evidence. The availability heuristic leads individuals to rely on readily available information, often overlooking relevant but less accessible data. The anchoring effect occurs when people base their decisions on initial reference points, regardless of their relevance. These biases can significantly impact financial choices, and understanding them can help individuals overcome their influence. Prospect theory and loss aversion. Prospect theory, proposed by Daniel Kahneman and Amos Tversky, is a fundamental concept in the psychology of money. It suggests that people tend to make decisions based on perceived gains and losses rather than final outcomes. Loss aversion is a specific aspect of prospect theory, where individuals feel the pain of losses more acutely than the pleasure of equivalent gains. This aversion to losses can lead to risk-averse behavior and influence investment decisions. Money scripts and early experiences. Early experiences and cultural upbringing significantly shape an individual's money scripts, which are the ingrained attitudes and beliefs about money. These scripts are often passed down through generations and influence spending habits, saving behavior, and financial goals. Identifying and understanding one's money scripts can provide insights into their financial behaviors and assist in making positive changes. Time preference and delayed gratification. Time preference refers to an individual's inclination towards immediate gratification or delayed rewards. Those with a high time preference tend to focus on short-term gains, while those with a low time preference prioritize long-term financial planning and delayed gratification. Recognizing the influence of time preference can guide individuals towards better financial planning and goal setting. Herd behavior and market influence. Herd behavior is observed in financial markets when individuals follow the actions of the majority, leading to market bubbles or crashes. The fear of missing out, FOMO, can drive people to invest in assets that are already overvalued, leading to potential losses. Conversely, the fear of further losses during a market downturn can lead to panic selling. Understanding and avoiding herd mentality can prevent rash decisions driven by the crowd and promote more thoughtful financial choices. Financial personality and individual differences. Financial personalities vary among individuals and impact their risk tolerance, investment choices, and debt management strategies. Some individuals are naturally more risk-averse, while others may be comfortable with higher risks. Recognizing one's financial personality can aid in developing a personalized financial plan that aligns with individual preferences and objectives. Financial well-being and emotional awareness. The psychology of money emphasizes the link between financial well-being and overall happiness and stress levels. Financial stress can have a detrimental impact on mental and emotional health. Achieving financial literacy and emotional awareness are crucial for promoting financial well-being and reducing financial stress. Understanding how emotions and attitudes towards money affect mental and emotional health can lead to better financial practices and a higher quality of life. Gender and cultural influences on financial behavior. Gender and cultural differences can significantly impact financial attitudes and behaviors. Societal norms and expectations, as well as historical factors, shape how men and women perceive money and engage in financial decision-making. Women tend to be more risk-averse, while men may be more confident in their investment decisions. Cultural values and beliefs about money also play a crucial role in financial behaviors. Understanding these influences can help tailor financial education and services to cater to diverse needs and preferences. Behavioral economics and nudging. The insights from the psychology of money have found applications in behavioral economics, where policymakers and institutions use behavioral nudges to encourage positive financial behavior. Nudging involves designing interventions that leverage psychological principles to guide people towards better financial choices. For example, automatically enrolling employees in retirement savings plans or implementing Save More Tomorrow programs are nudges that promote better saving habits. Financial education and behavioral interventions. Promoting financial literacy and providing behavioral interventions are crucial for addressing issues stemming from the psychology of money. By equipping individuals with the knowledge and tools to understand and manage their financial behaviors, society can foster a more financially capable population. Financial education should be tailored to individual needs and delivered through various mediums to maximize effectiveness. The role of technology and fintech. Advancements in technology have revolutionized the financial industry. Fintech innovations, such as mobile banking apps, robo-advisors, and digital payment platforms, have made financial services more accessible and convenient. However, technology also poses challenges related to cybersecurity, data privacy, and potential financial exclusion for those without access to digital services. Behavioral finance in investing. Behavioral finance offers insights into the irrational behavior observed in financial markets. Concepts like the disposition effect, where investors tend to hold on to losing investments too long and sell winning investments too soon, and the herding behavior of investors during market volatility provide valuable perspectives for understanding market dynamics. Integrating behavioral finance principles into investment strategies can lead to better risk management and improved performance. Financial therapy and emotional money coaching. The field of financial therapy has emerged to address the emotional and psychological aspects of money management. Financial therapists and emotional money coaches work with individuals and couples to explore the underlying beliefs and emotions that drive financial behaviors. They help clients develop healthier relationships with money, overcome financial challenges, and achieve their financial goals. In conclusion, the psychology of money is a vast and fascinating field that unravels the intricate relationship between human psychology and financial decisions. Understanding and addressing the psychological influences on financial behavior can empower individuals to make wiser financial choices, improve their financial health, and work towards achieving their long-term financial goals. Policymakers, financial institutions, and individuals alike can benefit from this understanding to create a more financially secure and prosperous future.